Today we are here to talk about the Federal Reserve. So the first part I want to talk about is the structure of the reserve. So as you can see by this little tree to the side, there are different levels to it. The very top level is the actual Federal Reserve System itself. That is just encompassing the entire system, but where the majority of the information actually comes from is the three key entities. So the first key entity we're going to be talking about today is the Federal Reserve Board of Governors. The Federal Reserve Board of Governors normally has 7 members on the board. Right now, as you can see by the list of the current board members, there is only 4, but they are working on getting those other 3 members added. These board members are typically appointed by the president, but they have to be approved by Senate as well. They are normally only allowed to serve 1 full term, and a full term is 14 years, but that doesn't have to be consecutive years. If one of the members stops serving on the board for some reason, and they've only served 7 years, they can come back and be reappointed and serve their last 7 years as well to get to that full term length. Within this board, there are 2 special positions. You have the chairman and the vice chairman. These are also nominated by the president, but have to be approved by the Senate. These only have a term of 4 years, and that term does not affect the maximum length of 14 years. So if somebody is a chairman for 4 years, they can still only be on the board in a normal position for 10 other years. The next part of the Federal Reserve System we're going to talk about is the 12 Federal Reserve Banks. So the districting for these banks is a little bit odd when you look at it on a map. And that is because the way that the country drew out the districts was based on the trade regions when the Federal Reserve was initially created. Each region has their own bank, and you can see on the slides the list of where all the cities are that have the Federal Reserve banks. As you can see, they're all pretty major cities within those regions themselves, which makes sense when you think about those old trade regions. That's where these large cities came from, that was what was popular back then as well. Each of these banks, that while they do operate independently, they all still fall under the governor's board. One of the things that has been changing is, in history, these banks did operate a lot more independently than they do nowadays. Some of the things that's different is they might have different interest rates between them, which makes sense because when you think about each region differently, the needs of the regions are going to be different. But as the world has become more technologically connected, the banks have started working together a lot more on trying to standardize everything, because they realize that as the world keeps changing, they themselves also need to change. The last key entity we're going to talk about is the Federal Open Market Committee. This committee has 12 members. 7 of those members are actually the governor members. So right now, this committee is also a little bit short because of the fact that the governor's members are short as well. One of the things that they do is 4 of the members of this group are on a alternate system. So you can see listed up there the reserve groups. Those groups are linked together so that every year it moves to the next bank. So what it is made up of is the presidents of these banks. So this year the president might be from Boston, but the next year it might be from Philadelphia and Richmond. They try to do this to make sure that the representation for each region is fair. Even though all the presidents of the banks might not be on the board itself and a part of making the decisions, they are still required to attend all the meetings that are held. Each year there are 8 meetings held where they talk about the interest rates, what is going on in the economy, and what they need to do to make sure that they are able to support the goals of the Federal Reserve. There are some other members of the group. These are the people that aren't the presidents. Right now, they kind of have a little bit more of a say-so just by the fact that the governor's group is so short, but that is made up by the fact that they do have alternate members who are part of the committee as well. And with that, Carson is going to talk about the monetary policy.
Thank you, Alyssa. Now I'm here to talk about the monetary policy. The monetary policy refers to what the Federal Reserve does to influence the amount of cash and credit in the U.S. economy. This can affect our interest rates and the overall performance of the U.S. economy. When it comes to the Federal Reserve's dual mandate, there are 2 primary goals. are to keep stable prices and maximum employment. This just means that they're trying to ensure that the prices we pay for goods and services remain relatively stable over time, and whoever wants to find a job in the U.S. economy is able to get one. This also does not mean that the inflation rate and unemployment rate should be zero. The ideal unemployment rate is around 4 to 5%, and the ideal inflation rate is around 2%. In today's U.S. economy, the unemployment rate is at 3.9, and the inflation rate is at 7.9, which is the highest the U.S. economy has seen in the past 40 years. We're now going to talk about the primary tools of the monetary policy. The first tool we're going to look at is the reserve requirements. The Federal Reserve Act of 1913 required all depository institutions to set aside a percentage of their deposits as reserves to be held as either cash on hand or account balances at a reserve bank. The Act gave the Federal Reserve the authority to set the required percentage for all of these financial institutions. These institutions typically have an account at the Federal Reserve and use their reserve balances to meet requirements and to process financial transactions. The next tool we're going to look at is the discount rate. The discount rate is the interest a reserve bank charges eligible financial institutions to borrow funds on a short-term basis. These borrowings are known as the borrowing of the discount window. The rate is set by the Federal Reserve's Board of Directors, subject to the Board of Governors' approval. The level of rate is set above the federal funds rate target. As such, the discount window serves as a backup source of funding for depository institutions. The discount window can also be the primary source of funding under unusual circumstances. We are now going to talk about the open market operations. This is the most frequently used tool. It consists of buying and selling government securities on the open market with the aim of aligning the federal funds rate with a publicly announced target set by the FOMC. The Federal Reserve Bank of New York conducts the Fed's open market operations through their trading desk. We're now going to talk about the last tool they use. It is the interest on reserves. In October of 2008, Congress granted the Federal Reserve authority to pay depository institutions interest on the reserve balances held at these banks. This includes paying interest on required reserves, which is designed to reduce the opportunity cost of holding required reserve balances at these certain banks. The Federal Reserve can also pay interest on excess reserves, which are those balances that exceed the level reserve banks are required to hold. Now, Hope is going to talk about the interest forecast.
Thank you, Carson. We're now going to talk about the factors that affect the interest rate forecast. There are numerous factors that can affect it, but we've decided to talk specifically about three of the largest factors, which are the gross domestic product, the federal budget deficit, and inflation. The gross domestic product is a measure of economic activity. It measures the value of final goods and services produced in the United States. Economic activity is actually what affects the interest rates, but GDP is how this can be measured and can show the economic activity level of the U.S., so we'll be looking at that. The next thing is a federal budget deficit. A deficit exists when budgeted spending expends that of tax revenue. The United States government has experienced a budget deficit for the past 20 years. The last factor that we'll talk about is inflation. Inflation is the erosion of the purchasing power of the U.S. dollar. Right now, the United States is experiencing a period of rising inflation, and inflation is at a level that it hasn't been in years. We're going to discuss each of these factors more in depth in the following slides, and also talk about the specific impacts that it has on interest rates. This graph is provided by the St. Louis Federal Reserve Bank, and it shows GDP growth rate over the past 6 quarters. As is seen by this graph, the GDP has been steadily increasing over the past 6 quarters. Furthermore, we expect the GDP to continue to grow. According to the Philadelphia Federal Reserve Bank and experts, they base these growth rates on their forecast. So for quarter 1, we expect GDP to grow by 1.8% and quarter 2 to grow by 4.2%. In the third quarter, 3%, and the fourth quarter, 2.9%. Both historical and forecasted data shows that the GDP is growing. And when the GDP is growing, that shows that economic activity level is also growing. When there's a strong economy, people are more willing to spend money. They're not as apt to save it. And so that's why a higher GDP leads to higher interest rates, because there's a greater demand in the economy. And that's why we're expecting, based upon GDP, interest rates continue to increase. The next thing that we'll be talking about is the federal budget deficit. This graph displays federal budget data from 2002 to 2021. It's also from the St. Louis Federal Reserve Bank. The last time that the United States had a federal budget surplus was in 2001, and as seen in this graph, every year since, there has been a deficit. So what is the deficit's impact on interest rates? Well, we see that this year, the proposed budget also will lead to a deficit of $1,837 billion. And when this happens, the government has to borrow money because they haven't made enough in tax revenue. And when they need to borrow, that means that there's a greater demand for a supply of funds. And then this, in turn, leads to an increase in interest rates because of that higher demand. So we believe that given this budget for 2022 and the deficit, that interest rates are also expected to increase. The last factor that we'll talk about is inflation. Inflation can be measured by the Consumer Price Index, which is defined by the U.S. Bureau of Labor Statistics as the measure of the average change over time in prices paid by urban consumers for a market basket of consumer goods and services. And we see that CPI has risen to the highest level since 1982. And we see that's also risen by 7.9% over the last 12 months. This graph is from the U.S. Bureau of Labor Statistics, and it shows a 12-month percentage change in CPI for different categories throughout the year. The first category is all items, the second category is food, the third is energy, and the fourth is all items less food and energy. And what sticks out about this graph is that energy has skyrocketed. This is largely due to the Russia-Ukraine crisis and the conflict occurring over there, as the United States has taken harsh sanctions against Russia, one of our biggest oil suppliers, which has driven prices up. But energy prices aren't the only thing that's increasing. The food index for CPI has risen by 0.9% in January alone. And so inflation impacts the interest rate because it affects the cost of borrowing. Lenders demand higher interest rates to compensate for these erosion of purchasing power. This extra compensation is known as the inflation premium, and that's why rising inflation means higher interest rates. We as a company would need to offer an inflation premium in the form of higher interest rates when we issue bonds in order to compensate these lenders for their erosion of purchasing power. So based upon everything that we've discussed thus far, the historical and forecasted data for GDP, the budget deficit, and inflation indicate interest rates will continue to rise over the next 3 quarters. The Federal Open Market Committee may decide to intercede should conditions permit, should they become bad enough. If they were to do this, they would pursue expansionary monetary policy, which is basically to increase money supply and drive rates down. While this might seem counterintuitive with inflation, during the Great Recession, the FOMC implemented expansionary policies in order to encourage the American people to pump money back into the economy to purchase goods, and it was highly successful. So the FOMC may do this by decreasing the discount rate, decreasing reserve requirements, or buying back U.S. securities. So given the aforementioned data, in the March meeting of the Federal Open Market Committee, in which Chair Powell gave a press conference saying that the state of the economy was strong, that they would not be taking any significant action to affect interest rates. We believe that they can be expected to rise over the next 3 quarters. Which leads us to our recommendation. We believe that the company should issue the bonds this summer. Rising interest rates over the next 3 quarters indicate a higher cost of borrowing. This is based upon data from a rising GDP, rising inflation, and a budget deficit, combined with the limited involvement of the FOMC. We think that this is the best way to limit our liabilities by issuing bonds this summer rather than next spring when we expect rates to increase. If you have any questions or want to look into it more, we've listed our sources on the last 3 slides that you all are more than welcome to look at and get your own information. Thank you for your time.